The NYSE floor didn't just pause. It locked up like a vault when a blood-red ticker screamed AI valuations halved, vaporizing $1.2 trillion in 72 hours flat. One second the sector was riding high. The next, it was staring down a 50% cliff. How does an empire built on tomorrow's dreams crumble in the blink of an eye? The trading pit turned into a war room gone silent. Alarms wailed, phones buzzed like angry hornets, then dead quiet. Screens glitched, one monitor flared crimson with AI valuations halved. Traders froze mid-gesture, eyes locked on the red line like it was a live grenade pin. A voice cut through the hush, raw and shaky. "This isn't a drill, we're in free fall." The shot glides into a sleek AI lab, bathed in blue light. A CFO, jaw set, mutters into a scrambling secure line. 50 billion gone overnight, and the dominoes haven't even toppled yet. Her screen flashes a jagged line labeled Credit Crunch Index, climbing like a fever chart. Someone just called in sick, and the patient's coding. A drone skims Manhattan's spine, steel and glass giants gleaming under a sky the color of wet cement. One by one, their windows dim, flicker then fade like dying embers. A subtitle burns across the screen, from $1.2T to $600 billion in 72 hours. How did we get here? Cut to a stone-faced exec in a high-ceilinged boardroom, marble floors swallowing every footstep. He leans in, fingertips pressed together, and drops. Credit tightens. Every leveraged AI bet gets crushed. The camera holds, his face says it all. Concern, cold math, a whisper of what did we miss? The scene hangs. The question lingers. What role did the credit crunch play in this sudden collapse? I've spent over a decade watching tech finance breathe up, down, up again like a restless sea. Venture cash that once flowed like water slowed by nearly a third in the back half of 2023, investors suddenly dragging their feet after a record 2022. Source: Bloomberg. At the same time, the median price-to-sales ratio for AI-heavy tech firms slid from 15 times down to 9 times between Q3 2023 and Q1 2024, deflating the hot air that kept the bubble aloft. Source: FT. The Federal Reserve's 2023 Financial Stability Report flagged it early. Rising corporate debt and tightening credit were cooking up trouble across the board. Source: Federal Reserve. That squeeze is what's now throttling AI's balance sheets. Even Nvidia, the 800-pound gorilla, saw its AI revenue jump 45% year-over-year, but the company's own filings admitted it's now dancing on a razor's edge, sensitive to every macro gust. Source: SEC. MIT Sloan scholars say we're knee-deep in the AI hype cycle trough, where overpromising meets under-delivering, and a lot of startups are treading water just to keep their heads up. Source: MIT Sloan Review. All these signals collided that chaotic morning on the floor, turning euphoria into panic in a single heartbeat. So what's next for the scrappy AI upstarts? Will the credit crunch birth a leaner, meaner generation, or just push the madness underground to simmer? Stick around, this story's still writing itself. I'm not your financial guru. This is just the news, take it as it comes. The screen flickers like a vintage CRT booting, then jumps to a montage. 2021 Silicon Valley boardrooms, champagne popping for AI unicorn announcements. Quick cuts to 2022 bankers high-fiving over AI-backed loans with no collateral. Then out of nowhere, a 2024 graph plunges like a stock chart in a flash crash. Listen, I'm about to lay something ugly on you. We bought into the pitch, hard. Back then, 2021, 2022, even early 23, any startup that could spell neural network was skyrocketing in valuation. No revenue, no problem. A deck with a robot clutching a laptop. Boom, instant unicorn. And the banks, they dealt out loans like blackjack dealers in Vegas, branding it innovation financing. They called it AI collateral. What did that really mean? A PowerPoint. AI collateral, future-proof IP. Valuation, derived from projected market capture. In plain English, we have no clue what it's worth, but we'll act like it's huge. Cut to a former Silicon Valley CFO, let's call her Sarah. She sits in a dim room clutching a USB drive. No face, just hands. She dips it in water, then tosses it into a sink bubbling with acid. Now the story gets real. Sarah wasn't a lone rogue. She was inside the system. And she says to me, plain as day, "We knew the numbers were fake, but the money was free. So we lied to ourselves, every quarter, to investors, to regulators, to each other." The screen zooms onto a lone line of code on a monitor. ROI equals, dated 2023. Free cash doesn't merely permit misconduct, it actually rewards it. That's precisely what unfolded. Venture capital flooded AI startups at breakneck speed. Then, in the latter half of 23, the tap shut. Funding fell 27%. Not a trickle, a quarter of the money vanished in 6 months. Source: Bloomberg Sept 1, 2023. The music shifts, subtle, ominous synth pulse. The mood slides from hopeful to skeptical. But here's the kicker: this wasn't merely a startup issue. It was a systemic problem. Because while VCs tossed cash at vaporware, banks were leveraging that same fantasy. Traditional lenders, big names you recognize, started loaning against AI assets that weren't assets whatsoever. They dubbed it transformational credit. I call it fake collateral finance. Split screen. Left side shows a banker in a suit beaming at a loan approval screen labeled AI-powered growth loan. Right side shows a spreadsheet cell reading collateral, brand name plus AI potential. And get this, the regulators, they were watching. Yet they didn't sound the alarm until it was almost too late. In the 2023 Financial Stability Report, the Federal Reserve bluntly warned about rising corporate debt levels and tightening credit conditions. They marked it as a key vulnerability. Source: Federal Reserve, 2023 Financial Stability Report. In plain terms, we're sitting on a debt bomb and nobody's checking the fuse. Tightening credit, the moment the music stops. Now fast forward to early 24. The music did stop. Tech firms heavily exposed to AI saw their price-to-sales multiples tumble from 15 times to 9 times. That's not a dip, it's a plunge. Median value slashed by almost 40%. Source: Financial Times, Jan 2024. A line chart: AI stock valuation versus productivity growth. Two lines begin together in 2018. By 2023, the valuation line rockets upward while productivity crawls. The gap yawns open like a canyon. This is the hype cycle laid bare. We were promised AI would revolutionize productivity, unlock trillions in economic value. Yet where's the proof? Beat. Then a dry chuckle. The data is brutal. According to MIT Sloan Review, we're now in the trough of the AI hype cycle. Overinvestment? Check. Delayed ROI? Check. Reality catching up? Yep, it's here. Source: MIT Sloan Management Review 2024. And here's the thing nobody wants to admit. The hype wasn't just marketing, it was collusion. Startups puffed up their story. Investors gulped it down. Banks loaned against it anyway. Regulators turned a blind eye. Close up on a burning USB drive in a sink. The acid bubbles, the plastic melts. Why? Because the system was built for one thing: growth at any cost. And now that cost is due. But here's what blows my mind: nobody's talking about the feedback loop. The loop where AI hype hid unsustainable credit growth. Where each loan was justified by future AI dominance. Where each valuation leaned on the next funding round. It wasn't innovation. It was a pyramid scheme wrapped in code. And the pyramid, it's beginning to crumble. So how did we get here? Let's break it down. This isn't just a tech story. It's a credit story. And credit, my friends, is the real AI in the room. Screen cuts to black. A lone line of text appears. BLOCO2, the collateral lie coming next. The screen flickers to life and suddenly we're staring at a grainy selfie video. Some mid-level quant at a hedge fund leans toward the camera, his eyes bloodshot like he hasn't slept in days. "The models were rigged," he rasps, his voice cracking like dry kindling. "We used AI to predict loan defaults, but we never even considered a credit crunch. Stupid, or just criminal." That moment isn't just some dramatic setup. It's the first domino in a chain reaction that's about to topple the whole financial world. Just weeks before his confession, venture capital had already slammed the brakes on AI startups, sending funding plunging 27% in a single quarter. Source: Bloomberg. The warning signs were everywhere, but his team just kept cranking up the risk dial like they had a death wish. Now, fast forward to a digital mirror of Wall Street. A wall of screens flickers as an algorithmic trading engine suddenly screams into the red zone. Those AI bots programmed to sniff out the tiniest profit opportunities suddenly smell blood in the water. Loan default risks spike, and they start dumping everything in sight: stocks, futures, bonds, you name it. Credit default swaps detonate like firecrackers, each one now worth a fortune because they're essentially insurance policies nobody expected to pay out. The simulation's ticker turns a screaming shade of crimson. Systemic failure, 87% correlation. These aren't random numbers, they're the ugly truth of every model that ignored the tightening credit screws the Fed had been tightening since 2023. Source: Federal Reserve. Meanwhile, back in the real world, a boardroom in Washington is melting down. The CEO of one of the biggest banks, his hair slicked back like he's trying to hold onto some control, stands before Congress, sweat visible even on camera. "We didn't get the math," he admits, voice trembling. "No one did." He gestures to a blackboard smeared with equations that look more like modern art than financial models. The camera lingers on the chalk dust swirling in the air, a perfect metaphor for the chaos now seeping into every loan application and startup's balance sheet. But the damage isn't just theoretical. Out there in the streets, the ripple effects hit hard. Companies that bet big on AI saw their stock prices get hammered, with price-to-sales ratios crashing from 15x to 9x between late 2023 and early 2024. Source: FT. That isn't just a spreadsheet nightmare. It means payrolls get slashed, hiring freezes lock in, and entire neighborhoods face layoffs that ripple through families like a shockwave. The human cost: empty cubicles, foreclosed homes, and parents working double shifts just to keep food on the table. Even the titans aren't safe. NVIDIA, the golden child of AI hardware, posted a jaw-dropping 45% revenue jump from AI products. Source: SEC. But buried in the fine print, a warning: highly sensitive to macroeconomic shifts. That sensitivity is the fuse on a bomb waiting to go off. When banks pull back credit, the money dries up for AI startups, and suddenly those sky-high valuations aren't just overinflated, they're collapsing like a house of cards. Academics saw this coming months ago. A paper from MIT Sloan Review bluntly stated the AI hype train had jumped the tracks, with companies betting the farm on tech that's delivering way slower returns than promised. Source: MIT Sloan. The trough they warned about isn't a slow slide, it's a freefall, and right now, we're watching the ground disappear beneath our feet. The climax hits not with a news alert, but with a single tweet that spreads like wildfire. A sharp-eyed market watcher drops the bomb: if AI valuations keep halving, brace for a cascade of defaults across the credit market. The post explodes, retweeted by analysts, regulators, even that same quant from the selfie video. Within minutes, #iCredit crash is trending worldwide, and the numbers start spiraling. So what does this mean for the average person? It means the mortgage you thought was locked in could get called in tomorrow. It means your 401k might be riding a roller coaster you never signed up for. It means that startup you backed with dreams of changing the world might never get past the seed stage. This isn't some dystopian fantasy. It's happening right now, line by line, algorithm by algorithm. And as the camera pulls back, we see the quant again, older now, hollow-eyed, staring straight at us. "We built the house on sand," he says quietly. "The tide's coming in." The screen fades to black, leaving us with his warning echoing in the silence and the chilling question: who else is going to drown before we finally learn to read the waves? The camera drifts slowly across vacant office towers, their glass skins mirroring a suddenly hushed sky. The AI gold rush is over. But the damage is, source Bloomberg. "We figured the hype would keep the lights on forever, yet the credit crunch yanked the cord. Venture capital that once poured into AI startups slumped 27% in the latter half of 2023, a stark cue that investors finally came to their senses." Source: Bloomberg. Experts on panels now dub this the biggest financial experiment ever tried, and it flopped. The median price-to-sales multiple for AI-heavy tech firms slid from 15 times to a modest 9 times between Q3 2023 and Q1 2024. Source: FT. Those figures aren't merely cells in a spreadsheet. They serve as a pulse check on a system that over-leveraged hope. The Fed's 2023 Financial Stability Report cautioned that climbing corporate debt and tightening credit were the perfect tinder for a fire. Source: Federal Reserve. The credit crunch didn't cause the AI crash. It simply peeled back the rot that had been simmering beneath layers of hype. Even the industry giants are feeling the tremor. NVIDIA, after a 45% surge in AI-related revenue last year, now concedes its market is hypersensitive to macro shifts. Source: SEC. The irony: the very engine that drove the surge now stands as the chain's weakest link. Researchers at MIT Sloan Review confirm the hype cycle is sliding into its trough, leaving countless firms over-invested and still waiting on ROI. Source: MIT Sloan Review. That trough isn't merely a dip, it's a warning that the current model can't hold up. So what's next? A kid in a classroom lifts her hand, eyes wide, and asks, "So, what's next?" The camera lingers on her face as the screen fades to black. Text pops up: "The system is broken. Fix it." Now's the moment regulators must tighten the reins. Investors need to demand transparency, and the public has to stay vigilant. If we ignore those warning signs, we risk another round of hype-driven ruin. Act now, push for smarter credit policies, enforce realistic valuations, and build a resilient AI ecosystem before the next boom turns to bust. Source: all above.